Thank you for coming out here tonight. I appreciate everyone investing their time here tonight. We have a great presentation lined up. I think you're really going to enjoy it, and I think you'll learn a lot as well. The topic, as you know, is how 2018 tax reform impacts you. We're going to talk about the Tax Cuts and Jobs Act, who benefits and who may potentially pay more. We're also going to talk about what corporations are actually doing with the tax cuts that they got. We'll go into the investment landscape, talking about investments that are likely to be positively affected by tax reform, and also some investments where there's potentially some risk. We're also going to have a Q&A, so this could be an interactive presentation, particularly at the end. Our speaker tonight is uniquely qualified to talk about this topic. His name is George Koeltl. He is a certified financial planner. He's been with Reby Advisors since 2005. Prior to joining Reby, he was a wealth advisor at UBS and Merrill Lynch. He was also a corporate tax auditor for New York State Department of Tax and Finance, and he has passed the CPA examination as well. He's a chartered retirement planning counselor, certified divorce financial analyst. Please join me in welcoming George Koeltl.
Let's hope none of you need my certified divorce financial analyst credentials. So we're going to talk about taxes. One of the what should I say, Rebyisms that we have at our firm is it's not what you earn, it's what you keep. And so taxes play a very big part in certainly in retirement planning and even in the wealth accumulation phase. So we're going to try to touch on those things. We're going to try to keep your eyes open, because if you're going to plan taxes for 2018, we can't wait till November or December or the day we go to see our tax accountant. It has to begin today. So we're going to try to highlight some things, and you're going to have homework to do to go home, take a look at your current 2017 tax return that you've filed or are prepared to file, check out your certain things that we're going to highlight tonight, and then you're going to be better served to plan for 2018. So I know this is too small for everybody to read, but this is what we call Schedule A on your 1040 tax return. That's where we get to have fun by taking away some of the income that we put on the front page of the tax form. So we have medical and dental expenses, taxes we pay, interest, gifts to charity, and then casualty and theft losses, and miscellaneous deductions. There are changes that have happened. For medical expenses, it's going to be 7.5% for this year and for 18, and then it's going to go back to 10. But for most of us out here, medical expenses make up one of our biggest deductions on our tax return. For a couple, if you have Medicare and supplemental insurance, that's going to run about $8,000, maybe $8,500. If you were thoughtful enough to have long-term care insurance, that would be for a couple around another $12,000. So now we're up at 20, and on top of that, you have non-deductible medical expenses like hearing aids and things like that, plus dental expenses. Now we know why George Washington had wooden teeth. It was very expensive to go to the dentist, so we went to the carpenter. But in jest, so what I want to say here tonight is medical expenses are a big part of this year's 2017's tax return, but it's going to be even a bigger part going forward, because you're going to lose some of your other ones, and they're going to be reduced. So what we want to do with medical expenses, especially dental, is bunch them. What does that mean? That means if Jack has a toothache, Kathy needs to have a toothache. So we bunch all of our medical expenses into 1 year, okay? Taxes you paid. Now this is a big one you've heard about, because if you're in Connecticut, New York, New Jersey, California, or any of the higher tax states, Massachusetts tax states, we used to get state and local taxes that you paid, like income taxes. On top of that, you used to get your property taxes. And if you had second homes, you had more property taxes, and maybe more. So That's going to be capped at $10,000, and that's going to be that's going to have a big impact on a lot of folks, because that's going to be, that you could be losing $10, $20, $30,000 worth of deduction in that spot. Interest you paid, really no big effect other than the fact that you're capped at $750,000 on the basis of mortgage interest. So you have more than a $750,000 loan, you're not going to be able to deduct more interest than that level. But that's only going forward, not backwards. Gifts to charity stay the same, though. In a way, it increases the amount that you can deduct in one particular year. It goes from 50% to 60%. It only affects you if you're giving like gifts to your college of, $250,000 or something. Casualty and theft losses, they go away except for unless you live in disaster areas. And for this particular meeting, I just checked New York and Connecticut aren't disaster areas, so it doesn't matter.
Danbury's a disaster.
Huh?
Danbury's a disaster.
Yeah.
I didn't say that.
And then the one that really is going to impact a lot of folks, for at least that we work with, is the miscellaneous deductions, because that's where you would put your fees. So any fees that you would have for management fees and stuff, that would be there. So what I want to tell you is there's been some adjustment here, and whatever your total deductions were in 17, they're not going to be the same in 18. But there's a positive side. The standard deduction has gone up for a married couple from $13,000 to $26,200. When you hear 10 to 24, but you get the personal exemptions as well still. So you got 26.2. So what I want you to do for homework, now everybody pay attention, is you're going to take all your expenses and you're going to cap these at 10, you're going to take away your miscellaneous, and you're going to check to see if you're north of 26.2. Because if you're not, then you're not going to itemize. And if you're not going to itemize, then we have to do other things to make sure we maximize our deductions. So what can we do because if you don't itemize your income taxes, you have no charitable deductions anymore, right? You have to itemize to get a charitable deduction. So for those of us who are lucky enough to be over 70 and a half, you have to take what they call a required minimum distribution from your IRA every year. What we can do is give our money to charity by utilizing our required minimum distribution. So I'll give you an example. I give $10,000 to a charity, multiple charities over the course of the year. I have to take $50,000 out of my IRA because the government said, it's time, you waited long enough, you have to take that money. As long as I give that $10,000, as long as I call Roseanne, is the only way I can explain it. Call Roseanne and tell her what charities you want her to have Schwab issue checks for. Schwab will send you those checks, and you will then be able to take it out of your IRA. You cannot take the money and then give it to the charity. That's not how it works. It has to go to Schwab, to you in the name of the charity, and then you give it to the charity. It also has to come out of the RMD portion. So you have to do it if you have a $40,000 required minimum distribution, you have to give it out of the first 40. If you don't, and you try to do it later, there's a good chance Schwab won't even allow to write the check because you'll have already used up all your required minimum distribution. So my advice to all of you, call Roseanne. She's going to be a busy girl. So there are some additional changes for families. The Affordable Care Act had a mandate that if you didn't buy insurance, you had to pay a penalty. That's gone. Tax rates are reduced, so the old 12% is let me get this right. 15 is 12, 25 is 22, so on, so on, so on. But they're all reduced a little bit. Child tax credit doubles to $2,000. For your estate planning purposes, for only if you qualify. It doubles the exemption on the estate tax, so it went from 5 million whatever to 10 million whatever per person, so now it's 22.4. So I don't think anybody in this room will be paying federal or state taxes. And expanded use of the 529. So if you guys have been starting 529s for your grandchildren or you had them for your children, and there was always, I can't use this for private high school, and you know, we're always sort of like wishing we could, you can now, but it's capped at $10,000. So if you had a prep school and you had money in the 529, you can now use it for your 529 for that prep school. But max $10,000. Before we get there, I just want to say one thing, and nobody's talking about it, and I don't understand why, because it's been the most punitive tax on individuals since 1986, and that's the alternative minimum tax. And the alternative minimum tax was put into effect in 1986 to catch all the people who were wealthy. But they never indexed it for inflation, so what wound up happening was any married couple with making, say, north of $180,000, right? Husband's working, wife's working, and you're in the Northeast, that's not you know, rock and rolling. You could be subject to the alternative minimum tax. And that, what would happen there? Well, you'd lose all your deductions right up front except for mortgage interest, and maybe if you had a mine somewhere or oil depletion, or, you know, those are the things they allowed you. So they also phased it out. So after $164,000, the phase out started. By the time you got to like $250,000, you had no deduction on the alternative minimum. They changed it. So now they made the deduction from $70,000 to $109,000. That's good. But the phase out doesn't start till over $1 million. So really, the people that are making between, say, $250,000 and $500,000, they'll never see the alternative minimum tax again. The people over that, you know, did they stretch it out a little bit more than they had to? Maybe, but at least the alternative minimum tax was hitting probably 60% of the middle class families. So I just wanted to, it doesn't get talked about, but it's a big deal. Corporate tax law changes. You know, when Reby advisors started talking about tax law changes in January 1st of 2017, because, you know, after Trump came in, that was the number one item on the agenda, where we're going to cut corporate taxes. Well, we were excited about it. And so we've been talking about it, and you know, we're excited for our clients, you know, because we are the investor class. This is what we live, this is how we make our living in retirement. You know, how does our portfolio perform? So this is all good. So is it good for investors? Corporate income tax cut from 35% to 21%. Is that good? I'd put a check mark next to it. Repeal the alternative minimum tax. I don't know that many companies that were paying it, because again, it's a way to keep a company that is hiding everything they can to, you know, to pay some tax, but they repealed it. Exempts corporations from future U.S. taxation on overseas earnings. It's not as clear cut as that, but it does, the idea of this law, and it does cap certain things, is to make sure that companies don't move their stuff to Ireland, or to some other Bermuda, or some other place. So they're not taxing them, you know, where you wouldn't bring the money home if you were going to be taxed at 35%, right? Why would you bring it home and pay 35% tax when you can leave it there, invest it over there, and pay no tax? So they made it better. This is a big thing. Reduce the tax rate on repatriated foreign earnings. So, as I said a second ago, you had a boatload of companies that didn't want to pay 35% on all of their subsidiaries' overseas earnings. So you didn't have to, as long as you left it there. Interest rates being so low, even if a company wanted to share with you all those great profits they made overseas, rather than bring the money home and pay 35% tax, they'd borrow the money at 1.8% and pay you a dividend out of that. I mean, it was getting convoluted. We needed to get that money back where it belonged, which is in the investors' hands and the corporate hands, so that they can create. And then the 20% deduction on personal income tax for pass-through income of small businesses. I'm not going to talk too much about this. I'm not an accountant. I just know that if you make more than $315,000 on your Schedule C on your tax return, you may be losing some of it, but don't hold me to that. So how do corporations benefit? Broad reduction taxation for individuals should spur stronger consumer spending. You You know, one of the things that, so having a few extra bucks in your paycheck is great, and we spend it because we can, but nothing makes a consumer more confident than watching his 401k go up or his investment statement going up. So when you hear about how confident consumers are, it's that 401k, it's those statements that you get from Reby that say how awesome you're doing. That's what causes you to be confident, because nobody's confident when it's going the other way. Lower corporate tax rate at 100% expensing may boost investment. You know, this has been tried before. It should. Don't know. Improve free cash flow for higher earnings. Listen, bottom line, to make stock prices go higher, earnings need to go higher, right? There's a correlation between the two. More profits, more earnings, higher stock prices. This tax law makes that happen. And then the whole thing about repatriation. So, was it needed? Was it needed, whether you believe in tax policy, whether you believe in, you know, Democrat, Republican, anything? Bottom line was we were back here. And all these other countries were a better place to have a business. And now we're here. So, of the largest companies, Germany's the only one that has a slightly lower tax rate. So we needed to be here in order to, you know, be a leader in the economic world. Okay, what are we going to do with this money? What are companies going to do? Well, I read yesterday, JP Morgan said that $80 billion is going to come through buybacks. Buybacks are awesome for you guys, because that means somebody else is buying the same stock that you own, right? It's the company themselves. Who cares? It's $80 billion of stock being bought. I'm an owner. There's less out there. That's good for us. Dividends, last time I checked, dividends are really what make earning, you know, higher and higher dividends are what make this S&P 500 grow. Mergers and acquisitions, we'll see. Capital investments, we'll see. You know, that's all about whether the companies can believe that if they merge with somebody else, it'll make the company stronger. And capital investments, do I need more stuff? Am I selling more stuff? If I sell more stuff, I need to have more capital invested. And employee compensation, we'd love to see that. You know, it's been a little flat for the last 10 to 12 years since 2008. And now with this extra money, it should be, and lower unemployment. The companies have plenty of money to give raises, and that's awesome. That would be a beautiful thing to see. So 17% invested in domestic capital. AT&T to invest $1 billion. You know, they're constantly increasing that high-speed networks and delivery of the internet and programming and everything. Comcast, another same kind of guy. And ExxonMobil, a new company, $50 billion. 13% in employee investment. So, you know, Lockheed Martin, that's beautiful to see. $5 billion in pensioners. We know, you know, the pension system is somewhat rickety. So that's a beautiful thing to see. JP Morgan hiring 4,000 employees, opening branches. That's great. FedEx, you know, pay increases, and another $1.5 billion of pensions. Those are beautiful things to see. And then finally, the increase in consumer spending. Corporations will benefit from consumer spending stimulus that's driven by tax benefits. Again, the whole concept of everything getting better, and consumers get better, they get more raises, they spend it. Estimates of $100 billion consumer tax savings in 18 and $200 billion in 19. And finally, Americans spend most of their free cash flow, which is good for consumer brands and the economy as a whole. I did want to say something about this. I'm having a... let's go on. So many of the raises and bonus announced one-time deals. You know, again, we'd like to see this continue on and on and on, but we don't know. Which investments benefit the most from tax reform? So because they're more domestically oriented, small cap stocks, just by its nature, are going to be more positively impacted by the lowering of U.S. tax, of the tax code. Mid-caps next, and then the large cap and mega caps. Now you might say to you, what that doesn't include, folks, is this repatriation of $2 to $3 trillion that's overseas, that's going to come in this year. Now, the tax law requires the companies to bring in those repatriated earnings this year. It isn't a choice. What they do have, though, is a choice on how they pay the tax. They could do it over an 8-year period. But that $2 to $3 trillion is coming in this sector. So don't be feeling that you got to run all your money over to small cap stocks to be taking advantage of this tax law. That wouldn't be a good thing to do. Now, I want to have a little tournament, so to speak, by asking the crowd here, who do you think has the most earnings to repatriate of all the companies in the United States today? Apple. Good answer. Who do you think's 2? No, that's not the right answer. Microsoft is the right answer. Cisco Systems. I mean, these are big numbers, though. You know, Apple, $256 billion sitting, already earned. They don't have to work real hard for this money. It's in the bank. And that's going to be coming over. They're going to have a big tax bill. But again, they're paying, instead of paying 35% on that money, they're going to be paying anywhere between 12 and 8%. Microsoft, $126 billion. Cisco, $98 billion. Google, $92 billion. Oracle, $59 billion. General Electric, $83 billion. They need that. Amgen, $38 billion. Gilead Sciences, $34. Qualcomm, $28. Coca-Cola, $25. You listen, all this money is coming back into this country, making it into the corporate tax coffers, and coming back to you, more likely you than the employees, via buybacks and dividends. And that's why we were so excited in 2017. Listen, we got a lot of those things happened already. They're not going to happen in 18. The stock market anticipated this happening. So a lot of this has been booked. However, what the stock market, I believe, is waiting to see is they heard that all this money's coming. They want to see it coming. So we're going to have, in 2 weeks, we're going to have companies reporting. And they're going to be reporting about how much their buybacks are going to be. They're going to be reporting about how much they're increasing their dividends. They're going to be reporting about any potential mergers they're thinking about. They're going to be reporting about higher earnings anyway because the economy's good. But I think we're in a show me kind of stage now. We've heard how great it's going to be, but we really have no proof, do we? Do we have any proof? Nobody's seen anything yet, so we're going to see it over the next couple of weeks. We'll see if that changes. Right now, all everybody talks about is the deficit, right? We put $1 trillion hole in the deficit. You know what? Last time I checked, the tax cut never hurt economic activity. So here are the different industries that could be affected by the changes in the tax code. So you would have thought that like tech would be way up here. Again, this doesn't take into account all those repatriated earnings. Telecom and industrials and consumer staples, materials, consumer discretionary, and financials. Yeah, I heard, my daughter works for HSBC, and I was talking to her boyfriend, and they had a difficult time. They had booked all these great losses from 2008. You remember when the banking system almost went under? Well, the positive side from a bank's point of view is they've recovered, but they have all those losses from that period of time. Well, when you reduce the tax rate by 40%, those powerful losses that they created also got reduced on their balance sheet by 40%. So, you know, that's just, that's accounting more than anything else. The pharmaceutical industry expects its tax rate to fall to 20 from 35. You know, they've been keeping, you know, you heard a couple of the names, Pfizer, Merck. They have a lot of money overseas, and they sort of play games with patents and things like that. But their tax rate will fall significantly. I'll give you an interesting one. IBM's tax rate is going from 9% to 17%, and their stock went down 2 weeks ago because of that. So it's going to affect different guys different ways. It's not as clear cut. Abby V from 19 to 9. So lower tax levies on repatriating these overseas profits, auto companies, banks, pharma, and tech have greater incentive to bring it back to the U.S. Telecom companies and industrials will stand to benefit by the increased deductions from capital investments, right? We talked about that earlier. They're going to expense 100% of a particular investment. That's a great thing. They have the money to invest as well. What I'm hearing more than anything, you know, as far as what's the best, you know, what's going to be impacted most directly from the tax code change, I'm hearing municipal bonds. So, but I'm not telling you to run out and buy municipal bonds, because remember, they yield 2.5%. What I'm telling you is that there'll be more supply out there, and there'll be more demand from them, because remember, in the beginning of this talk, we saw that our deductions got beat up. Well, if your deductions get beat up, the only way to work on your reportable income is by having some tax-free income. All right, so municipal bonds would be a way of reducing the income on your tax return, while on the other side you might be getting some lowering of your deductions. Negatively impacted? Well, insurance companies, you know, we have a problem in our healthcare system. So whether, you know, the individual mandate will hurt not only hospitals, not only insurance companies, but it's going to hurt individuals who are probably going to choose to go without insurance, because without the sword of Damocles hanging over their head, they will choose not to get an $18,000 policy, right? Which is the cost.
Projected to $10,000 a year.
The cost of insurance for a 60-year-old, a single person, is like $12,000 now, which is an awful lot of price to pay. Forget about a family of 4. Lowering of interest deductions, so certain, they are limiting the amount of interest that you can take on a corporate tax return. Again, that was going back to the concept, companies leaving money overseas, borrowing money to pay dividends, right? Because I'm paying so little, so now they're limiting the interest expense that companies are allowed to take on. Real estate, not much has happened there. The new tax code is going to increase the deficit by $1 trillion. That's not going to happen tomorrow, but like anything else, when we kick the can down the road, there's a price to pay. We'll figure it out when we have to figure it out. Debt holders could demand larger interest payments. I don't think that. I'm not going to stand here and say I'm an economist or anything, but level of U.S. debt to what the interest rates are a function of economic activity and monetary policy and a whole lot of other things than, you know, we have a lot of debt, because a lot of countries have a lot of debt. Higher percentage of taxes would be paid simply to pay off the debt rather than funding benefits or investment. Listen, we don't want to look at that pie chart tonight. We were here to talk about all the great things that tax cuts were going to do for you. So I'm not going to show you a pie chart that shows government debt and where the consumer spending is and how much we spend on interest or any of that kind of stuff. We're going to talk about all the positive things. So if there's some other things that you might have on your mind you'd like to put forward.
I have one question.
Sure.
The money that was overseas, that's anticipated to come back in the United States and be taxed, how will that affect the Treasury? In other
Well,
words, what do we expect?
there are some monies, you
What do
know.
we expect the Treasury to get?
Correct. I forget what the numbers were. It was like 300 billion. It was a good amount of money. Remember, it's coming back in over an 8-year period. It's not coming back in at the same time as the money's coming in. But they are going to get, the way I read it was, they're going to get 12% on 16% on cash and 12% on any intangible, like real estate that they own and things like that. So it's a lot of money. I mean, we've been talking about it, $2.5 to $3 trillion.
The reason I asked that question was, you said that we think that the tax cuts will increase the national debt by $1 trillion. But how much will that be offset by the amount?
That's all net. That's the net number. That's the net number.
That's my question.
So it could be worse, but I don't think so. Like, look, there's going to be growth. We don't know how much. These things have to play themselves out. Just like we have to see how all these great benefits are going to play themselves out. That's why we're starting to look at a stock market that's going waffling, going sideways. We got to see it. Show me what the impact is in real dollars, and you're going to hear it. You're going to see it come April, because people are going to have to come out and say, "What are we doing with this money we got?" They're going to tell you. Yeah, Joe.
With higher wages, lower unemployment, and a tightening of the Fed, looks like inflation may be closer than we had anticipated.
Not inflation.
Yeah, should we reduce?
Not inflation.
Should we reduce our exposure to bonds?
Inflation. We haven't seen inflation since 1982. So let's put it in context. All right? The major source of inflation is always going to be human wages and sometimes commodities, like what happened in the 70s. Anybody remember the 70s? Remember waiting online for gasoline, odd and even license plates, limited to $5 a trip, right? You remember those things? Every other week, gas prices would go up, the union would ask for a raise. Gas prices would go up, the unions would ask for a raise. By the time we had wage and price controls. It was wild. And then Reagan came in with Volcker, and Volcker raised short-term interest rates to 18% and choked the disease to death. And we haven't seen inflation since. Inflation's not bad. Inflation can be good. For an investor, it's awesome. Because I'm talking about bonds, Joe. Inflation is awesome. Because 40% of our portfolios are getting a yield. And a yield of 5% is better than a yield of 3.5%. It takes a little time to get there, and there's some price and there's going to be some price erosion to get there, but you're going to be getting 5% for the. Remember 5%, Joe? It was great. And so you might have bonds that lose 2 or 3%, 2 or 3% in getting there, but you're going to get there, and then you're going to be making 5, and you're not going to work for it. It's going to be an easy 5. It's not going to be reading the paper whether the market went up or down. It's going to be 5. So I say to everybody, listen, inflation's going to happen, but inflation's good. You know what the best part of inflation is? If I borrow $300,000 and 20 years later, and inflation was 3%, I'm only really paying them back $150, right? Because my dollar tomorrow is worth more, is worth more, because the debt became cheaper. Because of inflation. Inflation's not terrible. It's the other way that's terrible. When I borrow money from my house, and 5 years later, the house is only worth $200, my house is worth $600. That's deflation. That's the cancer. That's the cancer that kills. And inflation is something that can be, it's like you can always cut off your leg. Right? You can always cut off your leg. So, I don't want to go, you know. Am I getting a little bit out of control? You tell me. Yes?
I've already taken my minimum distribution for this year.
Yeah.
Does that mean I have to wait till next year to do the?
To do that contribution. That's what the unfortunate thing is. And, you know, we realized that last year. We realized that last year when we still had the deduction. You know, because folks, doing a QCD even last year was a good idea. Because what a QCD does is, if I had a $50,000 required minimum distribution from my IRA, it went on the front page of my tax return. Part of my adjusted gross income. If I give the $10,000 through my IRA, that number on the front page is only 40. Reduces my adjusted gross income by 10, and then my medical expenses get better, my miscellaneous expenses got better. My state taxes got better, right? In Connecticut, they just look at AGI. So if your AGI is lower, you're basically getting a deduction in Connecticut for that QCD. So, but it has to come out. I think it's sort of weird the way they did that, but I don't know if they catch you though. But you know, I believe as a Boy Scout, you should follow the rules.
think your plus is what you get.
Correct. Anybody else have anything? Listen, this tax code's not gonna mean a whole heck of a lot to us, but that doesn't mean it's not gonna mean $1,000 to the plus side. Doing the QCDs, we have a client who, what does he do, about 30,000, Roseanne? And he figured it out, I think it came out to be like $8,700 by doing the QCDs, because he doesn't pay 30,000, what's 30,000 times 6% almost for Connecticut? That's 1,800 right there. Plus on the federal, he gets more deductions because of the, the reduction of the adjusted gross income. So it's a great move. And what do we do when we want to do a QCD? Call Roseanne. All right. Anybody else? Listen, we look forward to each and every one of us, all of the advisors. We all talk with the same talk at Reby. There's no, Patrick doesn't, different styles, of course, but everybody says the same thing. We want to guide you through this tax code change. We want to work with you to make you confident in your investments, and we're going to get there to the other side where everybody does tax efficient in, income streams. So David, Patrick, Devon, we're all doing the same thing for our clients. All right, thanks a lot.
Thank you, George.